This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Dan Amerman joining us today. Welcome, Dan.
Thank you, Gord.
Dan, maybe we could begin with you giving our listeners a brief overview of your background and the things that you're involved with.
Okay, I am a chartered financial analyst. I am a former investment banker some years ago, and I guess you could say I've been moving to the light side of the force for some years now, away from the dark side, and have been working on educating different people around the world on some of the things that are happening right now and some things they can do about it. And a key thing that I have been working with for a long time is what I used to refer to as liability-based bailouts. And this is something that I worked in investment banking on the institutional side of the business with asset liability management and so forth. And what they understand that most people don't is that you can transfer wealth between different sectors of society just as easily by using liabilities as you can assets. You know, most individual investors just think about returns and net worth and wealth and things like that in terms of assets and returns on assets and things like that. But if you look at things from a governmental perspective, or you look at things from the perspective of a financial institution, it is every bit as easy to create wealth in the first place, or to take wealth from other sectors of society using the manipulation of liabilities and borrowing rates as it is in, let's say, returns in the stock market or something like that. And I feel that's absolutely essential information for understanding what's going on right now. And most people, unfortunately, don't understand that at this point.
Dan, that's exactly, you're 100% right, and it's exactly the reason we really wanted to have you on here today to talk about financial repression, because in fact it is a transfer of wealth, and it is not in fact lost wealth or destroyed wealth, and at least our belief. And so you brought some slides with you today that are outstanding, and a little different format than we usually do, because you have such a clear understanding of the subject. You've given it a lot of thought. I wonder if you could take our listeners through today these slides, and we'll go through them in a way that will really allow some of our listeners who are keen to understand the detail of financial repression will come away with a clearer understanding of it.
I think a good place to start is to move away from the term financial repression. And it's obviously, when someone says financial repression and you are a professional or you're an economist, that's a term that makes a great deal of sense. But I think oftentimes for people who are in the general public, that sounds like a very strange term, kind of like you're talking about a conspiracy theory or something like that, when that's the furthest thing from the truth. So the title that I used, is there a backdoor method for the government to pay down the federal debt using private savings? Because that's really what's going on here.
Financial repression to us, Dan, is nothing more than a way of, in fact, writing off the debt or reducing the debt or guaranteeing the debt servicing of the government.
Yes, in the narrower sense, financial repression in the sense that it's often used by economists is very much about the national debt. Now, in the broader sense, financial repression is a cycle that occurs between markets and governments over time, where at sometimes markets and private sector is far more important, and at other times the government really puts their foot down and they change the rules, so to speak, in the financial sector. And that's what we've really been seeing over the last 6 years. But to look at this from a national debt perspective, people are aware we have this fantastic sum outstanding. If you take the U.S. total of closing in on, we're not there yet, of $18 trillion in national debt outstanding, and of course this is just the openly admitted liability. It doesn't include all the unfunded liabilities and so forth. And you compare that to the number of households who have above poverty line incomes on the assumption they're the ones who are going to be paying the debt, the total comes to about $180,000 per household, which is just this fantastic sum. And people wonder, does that have any reality for my life? How does that really work out in terms of how it's going to affect my finances, in terms of how it's going to affect my taxes and so forth?
Especially, Dan, when you consider 84 million families today now live below $30,000 annual. That's a dramatic amount.
It truly is. It truly is. And we also have tens of millions of people who are planning on essentially living off investment earnings, primarily interest earnings in retirement. And this has, unfortunately, a very dramatic effect on that. But when we look at this fantastic amount of debt and we wonder how it can be paid down, or at least how the growth of it can be controlled, there's really four primary methods that nations can use to pay down huge government debts when they've borrowed in their own currency, and that's the key word, in their own currency. While our particular situation is unique, it's not the first time that we've had heavily indebted nations. We've had those plenty of times in the past, and there's certain methods that governments can use to deal with that. The first one, it may be the best example for, let's say, a household that was heavily in debt and something like that. And if you're heavily in debt and you're trying to reduce your debt, what do? You reduce spending. And that's the first alternative, which is austerity. Governments raise the taxes and they reduce the spending. Now, this is painful because of the size of the debt. It has to continue for decades. It fundamentally changes investment returns. And do voters understand this, Gord?
They do understand it. I'm just laughing here because Europe talked about it, and they managed to talk about it for 2.5 years before they finally stopped and gave up because every party got thrown out of power.
People understand what happens when their taxes openly go up and government spending openly gets cut with crystal clarity, and they don't like it, and politicians get voted out of office.
Exactly what happened.
Now, there's another alternative, and this is kind of the only other alternative if we think about a government as being like a household, like an individual, which of course they're nothing like, and that is taking, we'll call it the South American route, although this happened other places, and that is to default on the government debts, to openly just say, we're not going to pay you back. And of course, this can have a devastating financial and economic effect. And here's another next important question, I would say. Do the voters understand this?
I think so.
What are the political repercussions for politicians?
Not good. Not good at all. They're
absolutely devastating.
The defaults in Latin America 25 or 30 years ago really are indicative of that.
Yep. It's they don't want to do that if they can possibly avoid it. Now, there's a third alternative, and I was careful to use the words governments that can borrow in their own currencies. Places like Argentina can't do that anymore. That is open to a government that an individual can't do, and that is that they can use inflation to rapidly slash the value of the currency. So if we have $18 trillion in debt outstanding, and 2 or 3 years later this has a purchasing power of $2 trillion outstanding or $1 trillion outstanding, the government has effectively wiped out the value of its national debt, and it has passed that destruction over to savers and investors. Now, people may not think about this up front in terms of inflation, but what happens if people actually go through an 80 or 90% devaluation of the value of a currency in a very short period of time? People catch on, don't they?
Mm-hmm.
And does that have devastating political consequences?
Clearly, when they catch on.
Exactly. And the approach that I take in trying to understand what governments do and what the implications for investors are is that governments and politicians tend to look after their own self-interests. So clearly, there are great, big, huge problems for governments with any one of our first three alternatives.
A lot of people sort of understand inflation, and everybody understands taxation. Inflation, though, maybe not in the concept that it really is a form of taxation. It's a stealth tax. But what people don't understand is when it goes to the next stage. And that is when you've had inflation for quite a period of time, and yet your debt is still growing, and you're still not effectively inflating it away, and the kind of policies you then have to go to.
I don't really see inflation as being a tax. I know that some people do. I see inflation as being a redistribution of wealth.
Fair enough.
It is taking wealth from some sector of society and moving it to other sectors of society.
Because that's precisely what taxation is, a redistribution of wealth.
And I didn't mean to quibble with you there, but the only point that I'm trying to make, which is why I use the word redistribution rather than a tax, is that there are plenty of private parties who understand what is going on who are also benefiting from inflation. Mm-hmm. So it's not like things just pass through the benefit of the government. They pass through to others, like in many cases the banking system as well. So if we're looking at financial repression, this is a fourth alternative. And there's a certain beauty to it, which is from a governmental perspective, which is why it's been used in the past. And that is it's just complex enough that the average voter never really understands how it works. And because this is the case, the government can use this very powerful method of taking vast sums of private wealth year after year, decade after decade, and there's almost no political consequences.
Dan, you said it's been used before. Dan, I think that a vast majority of people do not understand that it was implemented after the Second World War and is perceived by governments to have been quite successful. And it really was. So this is not something new. This is not something untested. Maybe the degree of which it's being implemented is what's different.
Yes, I mean, that's absolutely true. And there's two things that really worked, and the two of them come together, which explain why governments like financial repression so much.
In fact, if I just interrupt, but you said that it came to an end in 1970. It's interesting that at that period we had the Vietnam War, that was the first war we charged. We had the Great Society of Johnson, which was huge debt. And so almost immediately after that, we came off the gold standard and went to a fiat currency in August of 1971.
Yes, it kind of unwound over the course of the 1970s and was mostly gone, but not entirely by the mid-1970s, only to reappear again in about 2008 to 2010. But the beauty of financial repression from a governmental perspective, and again, this sounds like such a terrible word, and what would people do if they know, and so forth. Think back to Happy Days. Think back to Leave It to Beaver. Those were the very peak of financial repression in the United States in terms of using the 5 principles we're getting ready to go over, the 5 ways of accomplishing it. It was all around people, but they didn't really think about it, and they didn't really vote on it. Now, the transfer of wealth was very much there. It was there continuously, but again, this was going on at a level where the average person never quite caught on into what was happening, so it was very effective for the governments.
Everybody would probably say it was one of the finest periods in America's history.
They would. And, but the bottom line is, it worked. It worked for the governments. And to understand financial repression, this miracle debt cure for governments, means we have to understand the source of the funding. And maybe a more technical way of phrasing this, and this is slide number 9, is that the essence of financial repression is using a combination of inflation and government control of interest rates in an environment of capital controls to confiscate much of the purchasing power of a nation's private savings. Now, that may be a little technical. In less academic terms, the government destroys the value of the dollar very intentionally over a period of many years, and it uses regulations or other interventions to force a negative rate of return onto investors in inflation-adjusted terms. So that if we're looking at the post-war historical example, the real wealth of savers was shrinking by an average of 3 to 4% every year. And what that meant was that people were paying down the national debt. They were doing it with their savings. They were doing it with their wealth every bit as much as if we had had an increase in tax rates or if we had had a very high rate of inflation. But because this was a fairly subtle process that occurred over a process of time period of years and decades, people never really fully caught on.
And therefore the government knows, as I said earlier, they know it works, and they know that there is typically no real ramifications politically to them.
As long as they don't carry it too far.
And therein lies the rub.
We are seeing a much more extreme form this time in that we have the near 0% interest rates, which is having a devastating impact on an older population. We have a lot more investments this time around. We have tens of millions of people who are planning on building wealth through their retirement accounts. We have all these retirees, this growing group of retirees who are planning on living on their interest income. And of course, what happens if you have near 0% interest rates? Well, their income goes away.
The biggest difference is the negative real interest rates for such a protracted period of time. Financial repression was, in fact, a protracted period after the Second World War, but not to the degree of the sustainability of those negative real interest rates. And by that I mean what we end up with, unintended consequences, moral hazards, distortion of pricing, distortion of mispricing of risk. And I believe that's what it's now led to.
Yes, I absolutely agree. And the other key thing to keep in mind about financial repression is because of the sheer size of the problem, most of the population, almost all the population that has the financial resources has to essentially be forced to participate whether they realize it or not. So a combination of, call them carrots and sticks, are used to make sure that most of the population remains on a playing field that has been more or less rigged against them, where their wealth is a little bit less every year rather than growing a little bit greater every year.
You're ring-fenced in through regulations, whether incentives or de-incentives or things like FATCA, whatever.
Absolutely. And I've got a slide, a graph, incidentally, on the 13th slide that shows the effectiveness of financial repression in the past. You look back to immediately after World War II, we're at about 90%. You look back to the early 1970s, we're under 30%, and then things started to go up again. And since the financial crisis of 2008, of course, we've had an enormous spike upwards around the world. And the specifics of financial repression took somewhat different forms in each of the advanced economies. They lasted for different periods of time, but they came down to two fundamental components. One is that there needs to be a mechanism for shearing.
I like that word. I think that's the appropriate word, too.
It's not a bad one. I mean, what do you do with sheep? You let them grow the wool, and then you shear off a bit of it each year, and then you let them grow the wool again, and then you shear some more off. Hopefully you never actually slaughter the sheep or anything or get them all riled up. It's just there's this process every year where you help themselves to a portion of their wealth, except you need to do this on an extraordinary scale without ever saying explicitly that that's what you're doing. And then the other thing that's mandatory to go along with that is using the government's control over laws and regulations to have a series of fences. So you can't really escape from the shearing pen, but you don't really say that's being done, or else to use an entirely different set of reasons to explain why it's being done. And in the post-war era, there were 4 to 5 characteristics that were in place in every nation. And number 1 was inflation. Number 2 was governmental control of interest rates to guarantee negative real rates of return. The third was the funding of government debt by financial institutions. The fourth was capital controls. And the fifth, and this wasn't true in every nation, but it certainly was in, say, the United States, the United Kingdom, and so forth, was discouraging or even outlawing precious metals investment, because that's one way for people to protect themselves from financial repression.
We have a history where we actually outlawed it or confiscated. I would say right now with the pricing, I'll use the word manipulation possibly, we certainly are discouraging it now today.
Oh yes, and this is something I've written about quite a bit, and I have a good bit of information on it on my website. But what we're really doing with our collectibles tax treatment in particular, with precious metals, is there is an ongoing taking that happens. That is, every time inflation boosts the value of precious metals, that becomes taxable income that then goes to the benefit of the government. Now, let's consider each of those 5 in a little more detail. One of them is inflation. That's the first half of our shearing blade, and that is that a government that owes too much money destroys the value of those debts, that is the government's liabilities, through destroying the value of the national currency itself. Inflation. It just really doesn't get any more traditional than that. We can look back over the decades, we can look back over the centuries. When governments get in too much trouble with debt, they inflate it away. And if you don't have inflation, now inflation doesn't need to be a high rate of inflation, but if you don't have some degree of inflation, financial repression just plain doesn't work.
So is this the biggest concern they're having in Europe right now, that inflation is falling? We have a deflation or disinflation, and they're doing everything they can to increase inflation? Is that the root problem?
There are levels within levels when we look at these factors. One of them is, how do we measure inflation? And do we measure it in a manner that is beneficial to the government or beneficial to individuals and so forth? And another fascinating thing that's going on is that there's really 2 different ways of explaining negative real interest rates, and both can be true simultaneously. One of them has to do with financial repression, and the other has to do with the issue of secular stagnation, which is particularly a problem in Europe and Japan right now, but I would say also in the United States. And that's with the idea that we have a long-term economic stagnation where we're not seeing the economic growth that we have in previous decades, and we have this very persistent level of high unemployment. Even though we're not really seeing that so much in the headline unemployment rates anymore, that's more covered up by changes in workforce participation rates. But the question then becomes, and this is what the European Central Bank is very openly talking about, and of course it's also the rationale for the Federal Reserve actions, is how do you take a stagnant economy and reboot it? How do you create economic growth? And what I'm getting to is the prescription for curing secular stagnation is identical to the 2 blades of the shears for financial repression. What the world's leading economists say is that you need to have negative real interest rates if you're going to create genuine economic growth.
Dan, my experience is that people have a real problem understanding what negative real interest rates are.
Yes. Yep.
People, naturally, smart people, can't get their mind or their head around that. Can you help them with that?
I sure can. The second part of the blade is that of holding interest rates beneath the rate of inflation. So if your interest rate is, let's say, in current circumstances, 0.25% per year, and you start off with $100, and you earn 0.25%, you end up with $100.25. Now, at the exact same time, let's say, and we'll use the government's figures on inflation for this, and we'll say that's fine, because you don't really need to go beyond that. I think the real rate of inflation is higher, but we'll stick to the government rate of inflation. And we'll say that the rate of inflation is 2.25%, which seems pretty innocuous. I mean, I think inflation averaged 3% per year for the last 50 years of the 20th century. But if we have a 2.25% rate of inflation, then, and the numbers aren't quite this way, they're actually multiplicative, not additive, but this works for illustration purposes. If you take that $100, let's say, and 25 cents, and you take off $2.25 for inflation, destroying the purchasing value of the dollar, you're left with $98. So you started the year with a purchasing power after tax and after inflation of $100. You ended the year with a purchasing power of $98. So the $2 differential between the 25 cents in income you had coming in and the $2.25 in inflation losses you had going out means that the real value of that's what matters, purchasing power, after you've paid your taxes, has gone down by $2. And it didn't just disappear into the nothingness. It went to the benefit of the government as the nation's largest debtor.
Because what it is an erosion in your purchasing power, and purchasing power is a direct function of wealth. That is what wealth is. No matter what you store it in, it's its ability to purchase whatever other thing you might want. And so that's why it's so critical. Now, how is that purchasing power effectively transferred as wealth to the government?
Okay. Let's say that we had, for round numbers, a $10 trillion economy, and we had $10 trillion in debt outstanding. Okay? Now, if we have just a level economy, all right, it would rise from being $10 trillion to $10 trillion and $20 billion. With just a 2%, keeping up with inflation, let's say at 2% at the end of the year. All right? And if what the government owes remains in value at $10 trillion, then they have just gained $2 trillion. I mean, they've just come ahead $20 billion compared to where they were. That is, it looks like the debt has stayed constant, but because the purchasing power of the national economy has risen in the meantime with inflation, whether it really gained or not, but the debt stayed constant, the debt is now worth less as a percentage of the national economy than you started the year at. Now, this may sound a little subtle, but it doesn't get any more real than that. Because let's say that we had private savers who started the year with $10 trillion in savings. Well, what happened was they lost that $20 billion in purchasing power, and it went directly to the benefit of the government.
That's well said, Dan. That's exactly the case, exactly. And like a shell game, you can watch the shells very clearly, but the pea did move.
Absolutely. The pea absolutely did move. And to make sure that pea keeps moving, that's where the fences come in. And the first one is funding by financial institutions. And the issue here is it was a little more traditional, actually, in the post-war era, in that people bought savings bonds. You know, if you had a little extra money from your paycheck, you weren't part of the country club set, you didn't have an IRA, you didn't buy stocks, you bought savings bonds. But not everyone did that. And most people these days don't directly buy treasury bills or anything like that. So if you're going to get the general population to participate with their savings in helping to pay down the debt of the federal government, you have to ensure participation. And the way that you do that is that either by regulation or other methods, you make sure that the financial institutions are funding the federal government. And then because the financial institutions are earning very low rates of return, that means they're only able to pass through very low rates of return to, let's say, their depositors on the other side. So in that way, you're getting the public to actually fund the federal government, and the wealth is taken from the public and it passes through to the federal government. And how this is usually done, and it's being done again right now, is in terms of mandating financial safety. We have all these risky organizations. We want them to hold safe assets, so they're required to hold government debts. They get very low returns on those government debts, and they then pay very low returns to savers on the other side, which means savers are steadily losing purchasing power. And I think there's a couple of fascinating graphs here in graphs 21 and 22. And what they track is the excess reserves of depository institutions. And what those are is it's essentially created money. That's how the Federal Reserve does it. They want to buy a security. It could be a treasury. It could be a mortgage-backed security from a financial institution. And what's very different about central banks is they can directly create money. That's what a dollar bill is. It is a liability. It's a Federal Reserve note of the Federal Reserve. So what they have done is they have gone from virtually no, this graph is just dramatic. They've gone from virtually no excess asset reserves in 2008 to over $2.4 trillion in excess asset reserves by this past summer. And at the very same time, let's go to the next slide, U.S. Treasury securities held by the Federal Reserve have climbed to over $2.4 trillion. What a coincidence.
Isn't that an amazing coincidence?
It's an absolutely amazing coincidence. And of course, these institutions are earning virtually nothing on the excess asset reserves they've been paid with. So the general public gets virtually nothing because it's the general public who actually came up with the $2.4 trillion in deposits that the financial institutions are using to purchase the Treasury securities that were then sold to the Federal Reserve and brought up the size of the Federal Reserve balance sheet while passing back virtually no interest income. So from that perspective, even though it's not usually presented that way, quantitative easing itself is a classic component of financial repression.
They allow the banks tier types of capital to classify the treasuries as totally risk-free.
Yep.
And in the fractional reserve banking system, how much money you can lend out is contained, but when is restricted in certain manners. But when it's treasury bills, it becomes almost unlimited, and it was changed in 1994. So there's a huge incentive for the banks themselves to hold the treasury bills themselves, even though they, in fact, aren't making any real interest on them.
Yes, controlling capital requirements, controlling perceived safety is, again, going to the very heart of classic financial repression. So if you look at it on a big picture basis, and you look at this $2.4 trillion in Treasury securities that are held by the Federal Reserve but are financed by the banking industry, what really happens is that because the banks and the Federal Reserve each have assets on the one hand and liabilities on the other, those net out. They drop out. And all you're left with is the general public funding the federal government to the tune of $2.4 trillion, while they get what, of course, is really not even 0.25% interest earnings on their interest-bearing checking accounts, their savings accounts, their short-term CDs, and so forth. And again, classic financial repression.
It's so simple and so easy to see, but so complex. It's amazing, isn't it? But you're a former banker.
Yes.
Was this something you clearly saw as a banker and trained as a banker, or is this something you came to realize later?
It's a combination thereof. When I worked as an institutional fixed income investment banker, yes, I absolutely worked with large numbers of assets and liabilities, and I learned to see the world in those terms. And if you do have that training, it's a very easy thing to do. But for the 99+% of the population who does not have that training, this can be kind of difficult to track, to see what's actually happening there. And then the other item that I've been working with, as I mentioned earlier, and I've been warning people about since 2007, 2008, is that we've had this total distortion of the cost of borrowing by the Federal Reserve that was really creating a massive flow of money from individual investors to the financial industry as well as the government this entire time. But if you don't have that background and if you don't have that training, if you don't have that type of education, this is very difficult for most people to see, even though I would argue it's absolutely essential.
Dan, when people that have worked in corporate and industry and have accounting training, and when they start to look at the accounts of banks and financial institutions where suddenly assets are liabilities and liabilities are assets. To a bank, a loan is an asset. To most companies, that's a liability. And the simplicity of this gets very confusing, and in there lies the shell game.
Yes. There are levels within levels in how things move around here.
And I encourage all of our listeners to continue to study, to read, and to review some of the things that Dan has said here, because you've made it very, 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 very clear and very, very simple. Dan, I don't want us to run out of time. You had a couple more things you want to say, but I'd like to make sure you leave with our listeners what they clearly need to understand and grasp.
Okay, let's go ahead and skip to the back end. And everything we've been covering here, incidentally, is part of a free book that I have available on my website at danielamerman.com. This is all covered in chapters 5 and 6 in terms of a more complete understanding of where this is coming from and then the effects on investors and so forth. But if you go to slide 26, I think this is just essential. And this is a very simple, from a financial professional's perspective, projection of interest rate compounding. I mean, people talk about the miracle of compound interest, and arguably that's really what traditional financial planning is based upon, is you invest money, it compounds, your money works for you instead of you working for your money, and at a future date and time, you then have a comfortable portfolio that can support you in retirement with some security and comfort. But it's really all based upon not so much making those monthly contributions I show. Here on this graph, I'm showing $200 monthly contributions every month for 30 years in a tax-deferred retirement account. What really matters when we look at our earnings is not so much making those savings or doing the savings payments, but the rate that it's invested at. So if we were looking at investing, let's say, old-time rates of 5% or 6% or 7% per year, then that $200 a month might bring in $94,000 in savings or $128,000 in savings. But what people don't realize, because most people don't think in terms of compound interest or exponential mathematics, is that when you cut off the interest rates, you totally cut off the fuel supply for everything they believe that's true about investing for the long term. And if we only have a 1% interest rate, instead of earning $128,000, we only earn $11,000 over 30 years. So that's catastrophic when it comes to building wealth for retirement. And there's a flip side of this too, and that is when we look at the type of income that can be supported in retirement, the type of lifestyle that can be supported in retirement. And tragically, you have millions of retirees who are very familiar with this right now because of what's been going on in recent years. If you look at, let's say you had in this case an example portfolio of $250,000, and you were looking at drawing it down over 20 years, well, if you were at let's say a 5% rate, you could draw it down at $20,000 a year. 6% rate, you could draw it down at almost $22,000 a year. At a 1% rate, you can only draw it down at less than $14,000 a year. And that dollar difference, if you're a retiree, is huge. It's absolutely huge. Now, where it gets even worse, though, is the next slide, which is if we're looking at compounding wealth and then drawing wealth down. And in this case, if you could invest at 6%, and then draw down at 6%, that $200 a month would be bringing in about $18,000 a year. But if it's at 1%, you're down to just less than $5,000 a year, because the fuel is cut off for growing wealth in the first place, and then we have to draw down principal much more rapidly after retirement because we just don't have the interest earnings to live off of. So if you want to really understand what financial repression is doing to people, I think it's essential to understand the graph that I have on page 29, or I'm sorry, slide 29 here. And that shows in both before tax and inflation terms and then after tax and inflation terms how much real earnings we get from saving $200 a month every single month for a period of 30 years in a retirement account. Now, what the government is essentially doing is it's taking us from the middle of that graph there, and it's shoving all of us all the way over to the left. So if we look in pre-tax, pre-inflation terms at a 6% interest rate, we would have $128,000 in real earnings over those 30 years. If we go down to a 1%, we're down to just $11,000. But then we take taxes and inflation into account, and in fact, we're negative. We're negative $10,000 over that entire time period. And unfortunately, there's just no getting away from this type of math for savers and investors today.
Dan, I can hear our pensioners and our retirees cheering is because they're saying somebody is saying exactly what they're going through. I have so many people telling me this is what they're living on every day when they planned on their retirement, conservative retirement planning at 6%, and it says what's happening to them today. But, there's a flip of this. As bad as it is for those who've already retired and planning on retiring, all of the pensions out there, whether it's the state pensions that are now close to $5 trillion underfunded, the federal government $3 trillion, and probably corporate getting close to $1 trillion, we're not far off $10 trillion of unfunded pensions liabilities because of exactly this problem which they're facing. This is a crisis of huge proportions falling out from this.
Oh, that's absolutely true.
How does the government's strategy of financial repression end when it in fact is destroying the entire pension system of the country? Or is that too harsh a statement to make?
No, this is another area that I've been writing in for some time now. There's really two sides of financial repression we need to think about. One is the traditional side, which is the openly stated liabilities of the government right now, the openly stated national debt outstanding. The other and much bigger issue is the unfunded liabilities. And how do you make the unfunded liabilities not go away but reduce the negative impact of them? Well, you use the same two shears. You use inflation, and you have benefits that don't keep up with the rate of inflation.
Dan, there's so much here. We're just actually touching the surface, and I apologize for moving us along maybe a little faster than we would, but I know our listeners have only so much time. We've got to have you back to continue the discussion. Any last comments you'd like to make?
I would encourage people to come by my website. These are 2 chapters in a free book, and there's a lot more information there, and I hope it can help.
You have, Dan. You've made a big difference. Thank you very much for joining us today.
Thank you so much, Gord.
Bye.
Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.